Hi, I'm Robert Lindstrom with Provision Financial Planning, talking today about charitable giving. And charitable giving a lot of times kind of brings up images of very wealthy people using some trust and foundations to give money to charity. But what we're talking about today can apply to people who just give a little bit even. It's mainly around how to still get the benefit when you give and not itemize your taxes. The tax law of 2018 significantly reduced the amount of people that itemize, and because of that, a lot of people that do give to charity aren't getting the tax benefit of that. Which brings up a good point. You should only give because in your heart you want to. You don't give to charity just for financial reasons. But if you are going to give, you might as well get the tax benefits. First one is qualified charitable distribution, and a QCD is what people call it. But you have to be 70 and a half, so that's the big one. Once you are, though, and you're giving to charity, you can give it straight out of your IRA, and you don't even need to itemize to get the benefit of that, because typically you pull money out of an IRA and it gets taxed, but if it goes directly to a charity, no tax. So if you're over 70 and a half, you have parents or grandparents that are, make sure they know about it, because I really can't think of any reason you shouldn't do that if you are over 70 and a half. Next strategy is called bunching. And what it means is to bunch 2 years worth of giving into 1 year. So an example would be if you are itemizing, you get a $10,000 deduction for state and local tax. That's the cap now. And you have $10,000 of mortgage interest expense, and you give $3,000 to charity. So that's $23,000. Since the standard deduction is $24,400 if you're married, then you don't itemize. So the $3,000 you gave out of your heart, but you don't get a tax benefit for it. Instead, you can give $6,000 this year, so that's the $3,000 for this year and the $3,000 you would give them next year. You do it all in 1 year, and now you have $26,000 of itemized deductions, which is more than the standard. So you itemize, and so instead of $24,400, you get $26,000 of deduction this year, and then next year you would just do the standard, but you wouldn't give any money to the charity. Over a 2-year period, you end up getting to deduct more than you would have otherwise. So that's a very powerful strategy if you're a regular giver and wouldn't otherwise itemize. A donor advised fund is the next strategy, and it's not new, but it's gotten a lot more popular because of the bunching. So let's say under the same example that I just talked about, you don't want to give the organization the $6,000 this year maybe it's for cash flow reasons. They need it spread out. So what you can do is give $6,000 to a donor advised fund, and then you can get the tax deduction now, and then the money can go to the charity later. You get the $6,000 this year, but the charity gets $3,000 this year and $3,000 next year. And the last strategy actually doesn't really have to do with itemizing. Whether you itemize or not, you can do this one. But it's giving appreciated securities. So let's say you would, keeping with the same example, you would give an organization $3,000. But you also have a mutual fund or ETF or stock or bond or something that's $3,000 that has gone up since you bought it. So if you sold it, you would pay a capital gain. Well, you can give that security to a charity. A charity can sell it with no tax consequences, and then you use the $3,000 of cash that you were going to give to rebuy the same investment. And you're right back where you started. And in the future, when you do go to sell that investment, you're going to have a higher basis, which means you'll have lower capital gains than you otherwise would. So it's a win-win situation. All these could be very beneficial for you. So if you do give and you aren't itemizing, just at least take a look to see if any of these could be a benefit. Thank you.